Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate a consistent return year on year. So of course we need to open up our brokerage platform. The one I use is Tasty Trade. You can use any one you like. And we are obviously going to be using options contracts. So we need to know where we are in the options cycle. So the first thing you want to do is just pull up a list of expirations on an underlying. We're just looking at SMH at the moment. So we've got a list of expirations, weeklies and monthlies. Anything with an orange W is a weekly, anything else is a monthly. We want to stick to the monthlies and we want to be around 45 days out in time. So the next monthly available is October 18th. That's 16 days away and it is a little bit too short for us. So the next one down from that is November 15th, and that is 44 days out in time. And this is much more suitable for us. So now we know that we're going to be about 44 days out in time. We can pull up our watch list. This is just any watch list. You can make your own or just have a pre-made one. It doesn't really matter. And now what we can do is we can filter out any underlyings that have earnings over the next 44 days. The reason for this is we don't want earnings to disturb our trade. Earnings can mess up your deltas, increase volatility, and all of these things will have a negative effect on your overall P&L on that position. And we can also filter out things that have a low liquidity level ranking or rating. The reason for this is we obviously only want to be trading high liquidity stuff. We want to trade tight spreads and we want to be able to get in and out of positions nice and easy. So now what we've got left is a list of underlyings that don't have earnings and they're all very liquid. All that's left to do now is sort everything from high IVR to low IVR. The reason for this is because we want to sell when volatility is high and play the contraction back down to the mean and potentially even lower. And so that's why we want to be ranking everything or sorting everything using IV rank. So at the top here we've got FXI with an IV rank of 136, and at the bottom we've got CSCO with an IV rank of 8.8. So anything with an IV rank of over 50 is generally considered to have a high rank, and anything below 50 is considered to have a low rank. However, there can be times when an IV rank of, say, over 30 can be considered high, especially for ETFs. And it just depends on sort of what the market conditions are like. But as a general rule of thumb, above 50 is high. So as we can see here, anything above kind of this mark upwards is kind of what we want to be looking at. Just having a little look below, AVGO with an IV rank of 40, that still looks pretty nice. Nvidia, we've got an IV rank of 34.6. That's not the best. So with Nvidia, we wouldn't go with something. We wouldn't go with Nvidia with an IV rank of 34.6. But if this was SPY with an IV rank of 34.6, that's a completely different situation. So let's go down the list, and we want to keep in mind what we've already got in our portfolio. We want to make sure that we're not too heavily weighted in any one sector. We want to keep it nice and diverse. So just keep that in mind when you are going down the watch list and just see what kind of sticks out to you. We have got JD here trading at about $45.45. It's got an IV rank of 110.2. It's got 3 out of 4 stars on the liquidity ranking. It is a Chinese stock, and obviously with what's been happening lately with Chinese stocks, I'm not surprised why the IV rank is so high. If you were just to have a look at JD on the chart, so here's a chart for JD, and as we can see, it looks very wild, very crazy, a lot of gaps recently, a lot of gaps. Now, this might be a situation where you think you might actually want to stay away from something like this. I personally wouldn't mind trading this, and I don't really trade based on price action and what has happened previously. I look at what's happening now. Right now, IV rank is super high, and I know that if we can get a contraction in volatility, that will have a very nice effect on our P&L. So for me, I'm actually going to take a look at JD. So if we pull up the trade tab, we know we're going to be 44 days out, November 15th. We've got earnings on November 20th. Hopefully we'll be out of the trade by then. And now we're presented with the options chain here. And as we can see, we've got a horizontal orange bar. This shows you where the price currently is. As we can see, price is at 44.88, which is right in between 44 and 45. And the vertical orange bar shows you what the expected move is of JD over the next 44 days. So we know where price is and we know what the expected move is. So now all that's left to do is actually sell some contracts. So what contracts are we going to sell and where are we going to sell them? Well, there's two types of contracts, calls and puts. We are simply going to sell one call and then one put. And when it comes to where to sell them, I like to go for anything between a 15 and 20 delta. So if we come over to the delta column, as we can see here, the lowest delta we've got showing is the 19 delta, which is perfectly fine for us, right at the 60 strike. And then if we come over to the put side, we want to do the same thing. We found a 19 delta on the put side here as well at the 38 strike. So if we have a look at what we've done here, we've created a range, right? If we were to plot this on a graph to make it easier, we'd be plotting price levels at 38 and 60. Let's do that now. So 38 and 60. 60 is way up here. Okay, so 60 is about there, that'll do. So this is the range that we've created for ourselves. And what this trade basically is we want the price of JD to expire anywhere within this range at the point of expiration, which is exactly 44 days out in time. So as long as that happens, we can keep all of the premium that we collect. And that's literally it. That is the setup for this entire trade. Now, when it comes to premium, how much premium are we collecting and what is it costing us to put this trade on? So we would collect $237 up front as soon as the trade gets filled. As soon as our order gets filled, we'd collect that up front. And our broker is going to require $900 in buying power to open this position. So this is a really nice high return on capital trade. Obviously, because of where implied volatility is, you will get $7 of daily theta decay, which is really nice. And as you can see here, our contracts are placed just outside what the expected move is. Obviously, on the put side, it isn't quite outside the expected move. It would need to be at 37 for that, which we could always go with that if we wanted to. I mean, that's at 17 delta anyway. Anything between a 15 and 20 delta is fine, but you get the point. We're on the we're either on the outside of the expected move or we're right on the edge. And that's going to lead to a high probability of profit. As you can see here, we've got a 71% chance of success on this trade. And if we want to get out at 50% of max profit, we've got an 83% chance of success of that happening. So very, very high probabilities. And this is a very nice high return on capital trade for a naked position. And I wouldn't actually recommend covering this position by buying any contracts further out. By all means, we can have a look at what that would look like. So if we were just to go a little bit in on the call side and then buy the so we go at the 55, short the 55 strike, go $5 wide, $5 further out and buy the 60. So we just want to do the same thing on the put side. So we go $5 down, 1, 2, 3, 4, 5. Very simple at the 33 strike, $5 wide on either side. That massively reduces our buying power requirement. As you can see here, we only need about $360 as opposed to the $900. We do collect a little bit less buying power. The return on capital is still there. We get a slightly lower probability of profit, but because the return on capital is so high without having to buy any contracts further out, I would be tempted to go with something like this. This is a very nice trade. So with that being said, there is also one other thing you need to keep in mind when you are looking for positions, and that is the size of your positions. It doesn't matter what you know, if the sizing is wrong, it will eventually end badly for you. So we've got a position sizing template that everyone can use. It's completely free. And the way it works is you enter in the size of your portfolio. So let's say if it's $5,000, below that you will then enter in what the current VIX level is. Let's say if it's 25.3. Everything below will then be automatically calculated for you. And at this point, all you need to do is use this information to formulate the backbone of your portfolio. It will tell you how much buying power to allocate to undefined risk positions, defined risk positions, and how much of your portfolio you should allocate to short premium strategies in general. So everybody can get a copy of this for free. Click the link in the description and head over to the free position sizing template, and it will take you to where you need to go. If you want to get involved on the trades that we're making and you want to make money with us week on week, again, click the link in the description. This time, head over to EDS Premium and then get yourself signed up. Inside, you'll have access to all of our portfolios, small and large, so there will always be a position for you to copy. There is also a full course, so no prior knowledge is required. We will teach you everything you need to know. This setup allows you to learn and earn at the same time. It's also a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money-back guarantee. So if you studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free. Right now, it's £1 a month. The price will be increasing, but once you're in, you don't need to worry about price increases. You are rewarded for getting in early. With that being said, I will see you guys on the inside.